Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered with the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And thank goodness we have them, because we got a lot of news today, particularly out of the drug makers from the White House. So shares of pharmaceutical companies largely trading higher today as President Donald Trump's executive order was aimed at cutting U.S. prescription drug prices. It was sort of like the less bad news. It was better than feared. One area, though, will definitely be pharmacy benefit manager. Sam Fazeli is Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceutical Analyst. Sam, can you just walk me through why do we here in the U.S. pay more for drug pricing, and should that be reduced?
Yeah, so Alix, the thing in the U.S. is that it's a price that's set by negotiation between pharma companies and insurers, pharmacy benefit managers, and payers. It's not dictated by the government. At least it wasn't until recently. Whereas in Europe and many other countries, you have a single payer, and that's the government. And they play hardball, so they can get lower prices because that's the way they operate. And there are many situations where in the UK, the National Institute for Clinical Excellence refuses to believe or accept that a drug has got is value added, so it's not even offered, even at the negotiated lower price. So that's the issue here, which means that as soon as innovation happens, it's out in the market in the US. The day that a product is approved, they can get on and sell it. Over in Europe, it could take a year, 2 years for a drug to come through. So, and maybe with this new executive order, sometimes the companies will go, well, I'd rather not launch in Europe.
So is it realistic to expect that drug prices in the U.S. will come down, could come down?
See, the thing is, Paul, I'm having a tough time balancing this out. If the intention is to get the rest of the world to pay more, which of course helps the pharma companies, then I don't see how that helps the U.S. drug prices come down, right? If they aren't able to increase prices in Europe, then the government in the US is saying, well, you should give us the same prices you're giving elsewhere. Then innovation disappears, because at the end of the day, if you cut your revenue by half, you won't have, you spend 15% of that on R&D, guess what? Your R&D falls. Simple maths. So how this plays out would be quite interesting to see. And of course, we have to also remember that there isn't a price in Europe. So we just checked the price of Wegovy in the UK at the effective dose, $230, okay? In the US, Novo sells it for $499 to the direct-to-consumer. Okay, it's about twice as much, okay? So let's say in Europe it goes up to $300 or in the UK. How does that change with the US number? And we don't even know whether the company actually gives that price, because then there's a little small print. We have been doing the NHS has done a commercial deal. So what is the price? How is the U.S. government going to find that price? Unless they incorporate it into the trade agreements that they're doing, which is what should be happening here.
So so what about the PBMs? So that was singled out, the pharmacy benefit managers, as sort of the middlemen between insurers and the government and the drug makers, et cetera. What role do they really have, and are they the ones most at risk?
I would say they are the ones most at risk. I would say they should have always been the ones most at risk, because I don't understand the reason they exist in the middle. I mean, that's I can show you a chart of how the U.S. payment system works, and it varies by insurer. You can go from one job to another, and the cost of your drug goes up, right? Because you have a different insurance, or from one state to another. So that just really is untenable. And it's nice to see that the government, the administration, is now talking about making it easier to sell directly to consumers. So let me give you an example. We have data on the terminal that gives you an ability to calculate what a drug revenue should have been in the past quarter. Volume times price, right? Then you go and see what they actually reported. Sometimes for insulins, for instance, is 80% lower. 80%. Now, the PBM say, oh, no, we pass that on back to Medicare Part D. Why do you even take it? Why do we need to pay an administrator in the middle here?
That's a great
So
question.
what are your companies within your food chain there in the big pharma? What are they saying? Because this issue is new. We've been complaining about high drug prices forever. What are they saying as to what is likely to really happen?
They're not saying very much, Paul. And in these sort of circumstances, the best thing to do is to keep your head down and see how things work out. And of course, today it's only just come out. So I think they all, to a T, say the PBMs are a problem. We need to get rid of them. That's what, let's say that. But that's not today. That's been going on for 10 years. They also say Europe should pay more. But they also say that when you do the net price calculation, in many instances, I actually sent you a quote from Pascal Soriot, the AstraZeneca CEO, saying that actually in many cases the prices end up being about the same, maybe a little bit different. So all of that needs to be taken into account. And we need to decide if they're going to push Europe higher to pay more, is the US also happy to move some of the R&D to Europe? Maybe that's something that the European governments will ask for. Fine, we'll pay more, but bring some of your R&D here.
Right.
Bring more manufacturing here. Same arguments.
So 20 seconds. The drug stocks are higher. Does this make sense to you?
Yeah, but as you said, you got it right at the beginning, Alex, that this is not as bad as people expected. And also, I think we're in a world where sometimes the president uses his power to really push people into action. And then when he gets what he wants, the action isn't as bad as...
All right.
Yeah.
Sam, thanks a lot. Sam Fazeli, Bloomberg Intelligence. We really appreciate you.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get to some of the logistics here on the policy side. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joins us now. So a couple things to dissect. Obviously, one is the executive order for big pharma and drug pricing. The other is, of course, U.S. and China slashing tariffs. Here's what I don't really understand. If we're going to go back to tariffs that were roughly where they were before the 145% and the 125% on the respective countries, why are we getting this sort of celebratory tone in the market?
Well, I think it's just because it's the idea of this pause, that the worst case scenario is maybe not the worst case scenario. But, I go back to what Treasury Secretary Scott Bessent said this morning in his interview with Jonathan Ferro, and I'm paraphrasing here. He said, look, the 145% was because of China's retaliatory nature. If you go back to April 2nd and look at the Liberation Day of that 34%, it's a little bit more in line today with that 30%. So I think the market is going to wake up in the next day or so and realize that tariffs are going to remain elevated. Yes, it's not going to be as much as 145%, and that's a good thing. And maybe it opens up the boats so that they can start coming into the west coast of the United States, and we begin to, alleviate this idea of, shelves being empty and so forth like that. But elevated tariffs are still going to be here, and that's going to be the norm. We're really working towards this case scenario where it's like a 10% baseline tariff, maybe a little bit higher for other countries like China, with special exemptions, maybe for automobiles, pharmaceutical, tech, you name it.
Hey, Nathan, to what extent did politics play a role here? Folks on the Hill, maybe Republicans saying to this White House, hey, we got some elections coming up, and if we're talking about these super high tariffs, that could be a problem for us.
Yeah, I think there was probably more politics here than the White House is probably letting on. And I think it's not so much the elections, but more so of those 4th of July barbecues. Because, if you think about it, and if you believe the idea that, a lot of these ships coming into the West Coast of the United States are down 30 to 40%. These are the ships that are bringing over items for the Christmas retail season. And if you begin to see a combination of, President Trump's comments on, well, maybe American children don't need $30, they get $2. And with some, empty store shelves, and with the idea that maybe that we're going to get to a situation where small businesses are really harmed from this, I think this was sort of the White House's way of saying, look, we need to also try and save some face here. I didn't think they were going to go down to 30%. I think they around 60 to 80% is where you would have asked me on Friday, I would have said. But, going to 30%, it does give the market a lot of breathing room. Yes, we have lots of negotiations that have to take place over the next 90 days, but it's something the market can actually work with in terms of clarity purposes.
I also wonder if there's breathing room now in terms of dealing with a tax bill and focusing on deregulation. What's the timing of both of those things there?
Well, so for the tax bill, this tariff announcement actually hurts it a little bit from the standpoint that the House Republicans were hoping to use $2 trillion worth of tariff revenue to help pay for this bill, which is north of $5 trillion. And, if you come out and say, look, we're going to go back to a 10% baseline tariff for everybody, at least what the situation is turning out to be, you're not going to get anywhere close to that $2 trillion. So now the question is, how are you going to pay for it? Now, there's going to be some markups this week, House Energy and Commerce, House Ways and Means Committee. By this time tomorrow, you'll know exactly where the House efforts are in terms of gutting things like the IRA or changing the tax, provisions of this country. But what we're telling our clients is just remember, the House is throwing the kitchen sink in with this bill. They're throwing in things that we don't think will even pass the Senate parliamentarian and wouldn't even get under the what they call the Byrd rule, wouldn't even fly through that. So look for everything to be thrown in and then things to be scaled back. The biggest question, though, is how you're going to pay for it. And I don't think anybody on Capitol Hill on the Republican side knows how they're going to pay for it at this point. And as a result, there is a possibility that this may not be permanent. They may be pulling it back and saying, maybe it's only worth 4 to 6 years worth of tax extensions.
What are the dates that we need to pay attention to? Because quite frankly, I am not paying attention. I am overwhelmed. But you tell me the date I need to pay attention here from what we're going to hear from Congress.
So for the next 2 weeks, you're going to see this debate in the House. Lots of headline risks. But again, it's just headline risks. Ultimately, we think a House vote will probably come at the end of this month or probably more likely in June. That's when the Senate's going to get it. The Senate's going to say, thank you very much. They're going to essentially throw it out, and then they're going to say, look, we will take and do whatever we want and send it back to you. We think that's going to happen around the 4th of July timeframe. This is also under the assumption that the debt ceiling remains in this bill. Because if the Treasury Secretary Scott Bessent said the X date for that debt ceiling is in August, Congress needs to wrap this up before then. So we're thinking ultimate passage in that mid to late July timeframe. If the debt ceiling provision is stripped out, if they aren't anywhere close to, coming to a deal, they'll have to do the debt ceiling separately. And then the real deadline for this is probably going to be the October-November timeframe.
In terms of then the market, as we sort of look ahead to that, what's going to be the next catalyst within the next week or week and a half? What are you looking for?
So I think it's going to really be the House deficit Republicans. This is Representative Chip Roy, for example. He just tweeted out about 20 minutes ago that he is not going to vote for a bill that he, in his words, would add $20 trillion to the deficit. Now, I'm not going to say that we think it will go that far, but, you are going to see a lot of statements from Republicans who are not happy with this legislation, and it's just part of a negotiation. So look for this sort of seesaw moment of, yes, we have a deal, no, we don't have a deal. But I think for the next 2 weeks, you're going to see more negative headlines than positives. And then sometime maybe around Memorial Day, I think the Republicans will start to get a better idea of what that plan is going to look like in order to get House passage.
All right, great stuff. Really appreciate it, Nathan. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get right to our next guest. James Abate joins us, Managing Director and Chief Investment Officer for Center Asset Management. James, we wake up this morning, it seems like maybe the trade environment's not that terrible, not that strict. What do you make about it, and what do you make of the market's move today?
Well, clearly, the announcement that the U.S. is going to cut tariffs on Chinese goods to 30% from 145% for 90 days, and then China is going to cut tariffs on U.S. goods to 10% from 125 is good news. It's a truce. Again, this is a 90-day cooling off period, though. We'll have to see what develops. Unfortunately, what we see with President Trump, though, is he continues to negotiate against himself in public. It's a little like watching the same person playing twins, like Michael B. Jordan on Sinners, who played the actor, or the actor who played the Winklevoss twins in the movie The Social Network. It's like the same person negotiating against themselves. So I think market's going to remain volatile, and it might be in country's best interest to just stall on reaching a trade agreement with the United States, given how we seem to be able to negotiate against ourselves and lowering barriers.
But to that point, does the market understand now that there is some kind of a Trump put? So is the reaction function on the initial headline now going to just be a little different?
It's possible, but at the end of the day, what we really need to see is the U.S. convert this current relationship, and China is the best example of a significant trade deficit in return for capital inflows, namely into our treasury market, with a trade deficit that somehow equals, inbound fixed investment. I think there's a lot of probability that we can accomplish that with the EU and Japan. I'm not so sure we can accomplish that with China.
All right, James, as a chief investment officer and somebody who manages money, other folks' money, what do you do here? How's your world changed in the last 4 or 5 months here?
Well, we're of the belief that the risk of recession has been reduced. So clearly, when you think about that, what sectors should investors be looking at? And we've been very much pounding the table that U.S. regional banks are poised to benefit from a number of tailwinds. One's a steepening yield curve, better loan activity, some degree of acceleration in M&A, and even an easing of regulatory environment. So, when you look at the regional banks, after the recent sell-off that we had, with many trading at price to tangible book multiples just above 1, they have what we believe to be the best asymmetrical opportunity in the market and see them as a prime beneficiary of increased U.S. onshoring and a movement of supply chains to domestic manufacturers. So, for us, the source of funds that people should be looking at are consumer staples, given the recent disappointment and not really being very defensive at all. And even the Magnificent Seven. We think the terrific opportunity for active management now is really quite unprecedented. And this pivotal moment away from the Magnificent Seven, away as the year progresses, might be quite strong.
All right, James, really appreciate it. Thank you so much. I don't envy your position at all. James Abate, Managing Director and Chief Investment Officer of Accenture Asset Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So we've already got some agreements here. Just 145% U.S. levies on most Chinese imports. That's going to come down to 30%. 125% Chinese duties on U.S. goods. That will drop to 10%. For 3 months to give the countries time to negotiate a broader agreement. So maybe they can get something done, and maybe a discussion between the two leaders can accelerate that.
Yeah. And that raises the question of what do you do with the markets, right? So you look at the rally and you're like, oh, you have lots of optimism, et cetera. But I wonder in reality how much of that is actually funds. You got a couple things going on, right? Commodity trading advisors, so they're called CTAs. You have volatility controlled funds. You have hedge funds where they sort of shift around based on how much risk they're allowed to kind of carry based on what the markets actually do. So Citi says that CTAs have flipped long on the S&P. They're max long on the NASDAQ 100 and now covering shorts in the Russell 2000 based on moves this morning, and that if you see kind of a change in the S&P, you're going to have to add on to this, meaning that just because you see a rally doesn't mean it's real extended fundamentals.
Yep,
is
interesting.
My whole fabulous point.
Well, that's good. I love Stuart Kaiser from the folks over at Citi with his notes are very clear and easy to understand. I appreciate getting those notes. Let's go to a pro here, Brant Standridge, President, Consumer and Business Banking at Huntington Bank. Hey, Brant, we've got just tremendous amounts of volatility so far here in 2025. When you go sit down with your corporate clients, how is it reflected in their activity? Are they sitting on their hands? Are they trying to move forward? What are you hearing?
Well, Paul, first of all, thank you for having us on the show. We are closely monitoring all the developments that relate to the broader economy, and today's announcement is clearly another data point. Our focus has been on our customers, and what we're hearing specifically from our customers is really more of a wait and see. All of the events of the last few months have introduced a higher level of uncertainty. And as a result, many of our customers are waiting to see what will happen and delaying some decisions to obtain more certainty.
So based on that, what are the expansion plans for Huntington? Like, are you doubling down here, or are you holding pat? Because a lot of companies are just like, we're in a wait and see mode. We're delaying, but we're not abandoning kind of projects. How are you guys thinking about it?
Well, we're continuing forward with our investment plans. This is an important proof point for our organic growth story. We're very bullish about our opportunity that exists in the Carolinas. It's a fast-growing, dynamic market. We already have 30,000 customers there. Our approach and culture have allowed us to attract some really fantastic and talented individuals. And our business model really resonates in the market, which is around local and bringing highly qualified bankers with local relationships to those customers, supported with national expertise. And so we believe that in times like this, those customers and those relationships are even more important. And so we're continuing forward with our investment plans, not just in the Carolinas, but across the country.
What are the areas that, for your clients, that you find most attractive? What are the sectors that you guys like right now as you approach your corporate clients?
Well, our business model is based on having relationships with middle market, commercial, and small business customers. And we do that across a wide variety of different industries. And then we support those local relationships with industry expertise. So we're not focused in on a specific industry. We're more focused on medium and small businesses and supporting their day-to-day needs.
Talk to me about the concerns that your customers are talking about and their needs and how that might have changed.
Well, going back to a previous comment, it has introduced uncertainty. Obviously, not being aware of what a product will cost or how the supply chain may be impacted causes businesses to stop and consider. And we're seeing changes almost every day, and businesses are figuring it out, and they're talking to their own suppliers, and that's clearly leads to uncertainty. So as these decisions are made, as things become more clear, we believe businesses will continue and resume any investment that's been delayed.
So, you know, a lot of folks are concerned that with tariffs, it's kind of the small, mid-sized businesses that might be impacted the most, the inability to take cost increases and pass them through to customers, unlike, say, a Walmart or something. Is that what you're hearing from your customers?
Well, I don't think they know at this point. Clearly, this is a time for us to be closer to customers and be able to support them regardless of the economic scenario. And we believe that we're well positioned to do this. But I don't think they know at this point. Everyone or every business certainly is impacted, and supply chains are impacted, and we want to be there to support them as they make decisions day to day. But at this point, it's a little bit early to know that.
There was a lot of deposit competition for savings that seemed to then hit the pause button. Where are we in deposit beta, and how do you stay competitive?
Well, we're very, very fortunate that we have a very granular deposit base. In fact, if you look at the percentage of deposits that we have that are FDIC insured, it's the highest in our peer group. And that deposit base has been quite stable for us. In fact, we've been able to grow it at a period of time when others have not been successful. So we're continuing to see that same trend. We've been very successful at continuing to grow the deposit portfolio. Obviously, as rates come down, interest expense and the cost of that deposit book has come down. And we will continue to monitor that closely. But it is the deposit environment has been competitive for some period of time. And I would say there hasn't been dramatic changes in the last number of months.
All right, Brent, thank you so much. We appreciate it. Brent Stanbridge, he is president, consumer and business banking at Huntington Bank, located in Columbus, Ohio. That is the bank of Mr. Matthew Miller. So how about that? Talk about a granular depositor right there. So we'd like to speak to some of these bankers at the mid-market banks to get a sense of kind of how the corporate and mid-size and middle market companies are behaving, and are they investing? How are they investing? So those bankers give us a good view there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.